On April 25th, 2019, Philip Morris International reported first quarter earnings results for the period ending March 31st. This video provides an update on the company's dividend safety using its most recent operating results. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. With that out of the way, let's dig into Philip Morris International's dividend safety. To begin, let's talk about Philip Morris's business model. Philip Morris is a tobacco company that came into existence when its parent company Altria spun off its international operations in March of 2008. The company sells cigarette brands such as Marlboro in countries outside of the United States. Philip Morris has a market capitalization of $121 billion, with annual sales approaching $30 billion. Philip Morris is one of the world's most popular dividend growth stocks. The company's current dividend yield is 5.9%. Moreover, Philip Morris is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 11 consecutive years. Because of this, Philip Morris qualifies to be a member of the Dividend Achievers, an exclusive group of dividend stocks with more than 10 years of consecutive dividend increases. Including the years that Philip Morris was part of its parent company Altria, the company has increased its annual dividend payment for 49 consecutive years. This would qualify the combined companies as a member of the Dividend Champions, an exclusive group of dividend stocks with more than 25 years of consecutive dividend increases. The company is not a member of the Dividend Aristocrats Index because of the spin-off from Altria. Looking ahead, investors interested in owning Philip Morris stock will likely be interested in the safety of the company's dividend payment. For the remainder of this video, we will discuss Philip Morris's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Philip Morris's dividend safety in the context of the company's current earnings. In the first quarter of fiscal 2019, Philip Morris generated adjusted earnings per share of $1.09, which compared favorably to the $1 of adjusted earnings per share in the same period a year ago. For context, Philip Morris currently pays a quarterly dividend of $1.14 per share, which implies a payout ratio of 105% in the most recent quarter. Looking out over a longer time horizon, the company's payout ratio is lower. Philip Morris generated $5.10 of adjusted earnings per share in fiscal 2018. The company distributed $4.42 of common share dividends during the same time period for a dividend payout ratio of 87% in the full fiscal year. Using earnings, Philip Morris's dividend appears safe for the foreseeable future, but it could be at risk for a cut if this metric declines. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Philip Morris's current dividend payment to its free cash flow. Philip Morris generated $1.24 billion of cash flow from operating activities in the first quarter of fiscal 2019 and spent $320 million on capital expenditures during the same time period for free cash flow of approximately $920 million. The company distributed $1.8 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 193%. Looking out over a longer time horizon, the company's payout ratio is lower. Philip Morris generated $9.4 billion of cash flow from operating activities over the last 12 months and spent $1.4 billion on capital expenditures for free cash flow of $8 billion. The company distributed $7 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 88%. Using free cash flow for just the first quarter, Philip Morris's dividend could be at risk for a dividend cut. Using the longer-term view of free cash flow, the company's dividend appears to be slightly safer, though we encourage investors to monitor the situation closely moving forward. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Philip Morris's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Philip Morris was not a standalone company until 2008, so that's the earliest data that we have its financial performance for. Philip Morris's performance during this time period is shown here. Philip Morris suffered a 2.4% decline in adjusted earnings per share in 2009. The company made a new high in adjusted earnings per share in 2010. More importantly, though, the company's earnings still covered its dividend payment, and Philip Morris continued its streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Philip Morris's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest rate would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the first quarter of fiscal 2019, Philip Morris had $29.4 billion of total debt outstanding. The company generated $206 million in interest expense in the most recent quarter, for a weighted average interest rate of 2.8%. The following image shows how changes to Philip Morris's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Philip Morris's weighted average interest rate would need to rise to above the 10.7% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Philip Morris's dividend safety moving forward. Thank you for watching today's video, which performed a deep dive on Philip Morris's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.